Good evening, my YouTube viewers. What I wanted to do to you today is I wanted to give you a presentation on an analysis that I did on the SAGE group. The last analysis I did was on Foster Wheeler, and obviously they had a lot of creative bookkeeping. Looking at the SAGE group is completely different analysis. It's a very established company that had very good financial statements. Their annual report was very robust. It was a lot of pages. It was 7 pages, so I can't go through every page, but I can tell you that it was very good. The revenue and the cost of sales decreased, but this was a slight decrease. And selling and administrative expenses increased, but still it didn't really affect the company. Earnings per share increased from 3.9p in 2013 to 17.04p in 2014, which served to instill greater confidence in the company. Consolidated balance sheet looked good, nothing unusual in it at all. Shareholders' equity statement looked good, nothing really unusual in it, except for the retained earnings were reduced because of a loss of post-employee benefits and a gain on long-term employee benefits. Consolidated cash flow statement looked good. The cash flow from operations, investing, and financing all decreased from 2013 to 2014, but still, nevertheless, it still looked like it was a good company, regardless, even though it decreased. Cash and cash equivalents, however, increased. Dividends, Sage paid dividends of 12.2p in 2014 and 28.13 in 2013. And that was because they had a special dividend in 2013. I just listed a few of their competitors, which would have been QuickBooks, SAP, Oracle, JD Edwards, and Navision. That's a few of the companies and software packages that would compete against Sage. We did an analysis of activity efficiency ratios. I did that on Excel and copied it from Excel over to Word. You can see for yourself the outcome of the ratios. And then I did an analysis of all the ratios that I carried out. The next thing we did an analysis of liquidity ratios, and you can see I did that in Excel, and I copied it, pasted it into Word, and you can see for yourself the results of that analysis. And then I went into great length to analyze the ratios. Did an analysis of solvency ratios, did that in Excel, and copied and pasted it into Word, and you can see the results of these calculations that I performed. And then I analyzed the calculations. I did an analysis of profitability ratios, did that in Excel, copied it, pasted it into Word, and then I analyzed the reading. The 5-point DuPont analysis, that was one thing that we did, and it had 5 stages to it, and basically the DuPont analysis is based upon the return on equity ratio, and what you do is you manipulate that return on equity ratio to give lots more ratios, a total of 5 in fact. And when you manipulate the return on equity ratio to give you your 5 additional ratios, then you can analyze it. And what that does is that gives you a more clear perspective of the investability of a company. So the DuPont analysis is something that really any investor would need to look at. It's a strong measure of how well a company's management creates values for its shareholders. The ratio can be vulnerable to measures that increase its value and also making stock more risky. Return on equity is therefore broken down to show investor the detailed analysis of the different parts of the formula. Of the DuPont analysis, it's important to note that all 5 values defined above have increased in 2014, which reveals the company has taken on greater risk, which ultimately would be borne by the shareholder. So the company's bearing greater risk. I would like to point in their annual report, they had an entire section on their risk, which I thought was very good. We did an analysis of valuation ratios. I did that in Excel and copied and pasted it into Word. Then we did an analysis of sales ratios. Basically what we did was we, all of the expenses, we divided them into sales to see exactly, what was going on with that. And as you can see, general, selling, and admin expenses increased. Finance costs increased. Actuarial loss increased. Post-employment benefits increased. And foreign currency adjustments in sales, well, that increased, but there had been nothing the year before. So again, that's something that needs to be looked at, because obviously their expenses have increased from 2013 to 2014, and they need to find out why these expenses are increasing. And then we did an analysis of the discrepancy between net income and cash flow, and I did that in Excel and copied it over to Word. My summary is Sage is a very sound company that is well worth investing in, even though it didn't do as well in 2014 as it did in 2013. It still did very well. It's still a very stable company. I didn't see a lot of the creative accounting that I saw in the other company that I had analyzed, which was really good to see that it's a reputable company. So that concludes this presentation on Sage. I made sure that you are able to look at the reading, so you can look at the readings yourself if you like and come to your own conclusions about the analysis. And I hope to see you in another presentation. Bye.